all of you with the election coming up, with future elections, to educate yourself, because that should be at the one of the most important things for everybody is how much is the government dictating that we give them, and have a voice and get me fired up real quick on that.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt Walters, and I'm here with Lee Mackey.
Good morning.
And today we're going to talk about some taxes and then whatever Lee wants to talk about, apparently.
We'll
I don't know.
Just hit a hodgepodge of
Yeah, he said he's got some topics, so we're
Yeah.
going to talk about that. So let's start with some stuff that you want to talk about. What do you have on your mind?
Fed rate cuts. You know, we've been talking about it. It's coming. October's the month. I think they meet in 2 weeks. We went from 50 basis point cuts. Now everybody's expecting 25.
Mm-hmm.
Do you know that it's a 2-to-1 odds now back to a 50 rate cut? And I don't understand why.
Yeah.
Retail sales came in today better than expected. The consumer is obviously not pulling back all that much. You know, inflation is not at 2%. Unemployment is high, but not too high. You know, you could, if you wanted to take the contrarian view, you could have a pretty good argument just to
Just like
let this
cut
ride.
now?
Yeah. I mean, if they did not cut now,
yeah.
the market would sell off, 5%. But, I mean, it is crazy that we can literally sit here in a podcast and make an argument for no rate cut, but yet 50 basis point cuts are on the table. It just, I don't know. I mean, predicting what the Fed's going to do in 2 or 3 weeks is almost impossible right now.
Yeah.
What are your thoughts?
Well, I mean, I think it's in this balance of there's this tension between what should happen and what should happen based on data and what should happen based on market expectations.
Yeah.
And
And
the
who-
market's
and
fully
who-
expecting.
And this is what bothers me is, who's running this? Is it truly economic data? I mean, because you hear them talk about the Fed.
Mm-hmm.
We're data driven. I mean, if that's truly all they look at, then things have gotten a lot better, but I don't think there's enough out there to warrant 50. I mean, yeah, you can make the argument for 25, but I don't know. I mean,
you look at like the 10-year right now, it's at
3.6.
3.63.
Yeah.
That's what YChart says right now.
And so,
Shout out to YChart.
yeah, so rates have come down without the Fed having to do anything.
Right. And so the argument to say they need to cut has a lot to do with, well, the spread shouldn't be that wide between the Fed funds rate and like the 10-year.
Correct.
Right. And so it's like, well, if this 10 years at 3.6,
And Fed funds is
Fed
5.25.
Fed funds doesn't need to be over 5, right? There
Yeah.
needs to be a spread. There's probably, 100, 150 basis point, like healthy. But that would put it at, 5. I
Yeah.
mean, if you're at 100 basis points, that's 4.6. 150, that's 5.1. So I personally hope they do a quarter basis point because I think it gives the market what the market wants, which is something.
Yeah.
And but we don't get too aggressive too quick on the Fed, on the cutting of rates, because I don't want to end up where and I'm not saying we're going to, but I don't want to end up where we were a few years back, where rates are at super, super low, even if they're not zero, super low, and then something happens and we need, a lever to pull to kind of
Absolutely.
spark things. It's like I would rather rates trend on the slightly higher side. Not saying I don't want them to come down a little bit, but
It'll just be interesting. Everybody, the world is watching, the meeting in October. We're beginning to see central markets in other countries begin to cut rates. And so, I think we will follow suit. I'm with you. I think 25 is safe. I think 50 would be quite aggressive in the environment that we're in. Anyway, stay tuned. We got 2 or 3 more podcasts between now and then, and then it'll get exciting. And
I mean, the 2 years at 3.56, 10 years at 3.63. So there's still a little bit of an inversion there, but they're just right there. Nothing like it used to be.
Correct.
So they've kind of been bouncing around right there at that. We talked about it last week of the uninverting process.
Yeah.
So they're kind of hanging out there together right now. So we'll see what the Fed does.
But retail sales coming in today, pretty strong. I mean, a recession does not appear on the horizon. A soft landing looks, quite probable.
I mean, the reality is the consumer's hanging in there, but people are being stretched, right? And the variance between, the upper middle class, and the wealthy, the people making a lot of money, and the lower class, and middle class and down is widening.
The gap is widening.
The gap is widening, because it is getting hard and tight for a lot of people.
Mm-hmm.
But depending on what you do for a living, depending on kind of the money you make, a lot of people are still doing really well.
Yeah.
So it'll be interesting. What else you got?
I don't know. Just a couple of things that caught my mind. One, we're not promoting any products or specific companies, but Amazon just continues to be a behemoth in what they're doing.
Behemoth?
Yeah, that's a big word for
It's like you saying indices instead of
indexes.
Yeah. I say behemoth, but
you look at more of these companies that are going out of business, the Walgreens they're closing stores,
mm-hmm.
and you can kind of point it to Amazon. I mean, Amazon is getting to the point. I think they mentioned on their last earnings call that in the last quarter, in the last year, 5 billion shipments were either same day or next day delivery. And the article I was reading was talking about, if you need toilet paper and toothpaste, well, you don't need to go to Walgreens or CVS anymore. I mean,
mm-hmm.
you're getting it brought onto your doorstep. Anyway, that was interesting. Apple's, new release. This has been a big one coming for their iPhones. All the AI that's going to be entering your phones now. But
Amazon's up 37% over the last 1 year versus when compared against the S&P 500, which is up 27%.
Yeah.
Amazon the other day, they announced bringing everybody back 5 days a week.
5 days a week,
which is wild when you think of where we were at and coming out of COVID, and everybody was just like, no one's ever going back to the office. Everything's going to be remote. There's no need. And it's a good reminder that don't get caught up in the moment, right? Because there can be change, and there has been change, and there'll be lasting change from that. But there have been a lot of companies that have reverted back and said, you know what, this isn't working as well as maybe we thought, or what it appeared to be in the beginning.
Well, they're sitting on millions of what's the word I'm looking for?
Like
square footage.
Square feet. Yeah, square footage.
I just went blank. And so, I mean, you're seeing it from, New York. I was at JP Morgan, a few months ago, and they're bringing everybody back in. They're building a brand new tower.
Well, Walmart, right down the street. They're bringing a lot of people.
And so, the tech industry kind of led it, at the beginning of everybody go home to work, and now they're bringing everybody back. And then my last little topic I thought was, all of a sudden, you wake up and you realize that Larry Ellison, I mean, who was a prominent tech guy years ago, is back to number 2 on the
can't get rid of him.
Can't get rid of him. He's number 2 on the world's richest list, man anyway. He just took over Jeff Bezos's position as one of the wealthiest people in the world, behind Elon Musk.
Dude, if you look at the chart, look at a chart of Zoom. I haven't looked at this in a while. If you look at this, so we were talking about the work from home. I mean, that is wild.
Well, if you look at Zoom, you look at
So look at the last 3 years. Zoom is down 75% over the last 3. And I knew they were down a lot, but I hadn't actually looked at the chart to see how much. But you look at their 5-year chart. I mean, it's like wild.
another one is Peloton.
Yeah.
I mean, the list can go on and on of companies that, overnight just went, you know.
What's a good reminder of how, what makes investing so hard, right, is not only do you have to get in at a good time, you also have to get out.
Yeah.
Right? Because if
Yeah.
you've held on to some of these names for too long, then, you likely gave up a lot, if not all of the money you made. So.
Interesting. So anyway, what do you got? Taxes.
Yeah, so my topic was a lot more boring, but also very important.
Yeah.
Taxes. So we talk a lot about tax planning and, how to, as advisors, we don't file taxes for people. We don't give tax advice, but we do tax planning. That's a big part of our planning process. And, our clients here is talking about it a lot. You've probably heard us mention on the podcast before. So just talking about what does that mean? Like what are some different ideas or thoughts that go into when we talk about tax planning? Sounds great, but what is it? So just wanted to talk through that. So tax plan, when you hear someone in the office talk about tax planning, what first comes to mind?
It could be anything from, right now we're doing Roth conversions, maximizing the current rate that they're in. It could be capital gains, trying to leverage current tax laws to maximize, capital gains. People don't like to pay income tax. It's kind of a way of life.
Amen.
But we try to lessen that as much as possible. I mean, especially if a client has got high income in a current job, then we don't need to exacerbate that problem with what we're doing as far as the types of investments that they're in. So, tax planning is a broad umbrella.
Sure.
Years ago, when the estate tax exemption was very low, that included, looking at estate planning. Yeah.
Oh, sure.
Yeah. And so it, tax planning can involve a number of different things. Typically, when clients come into our office, it is income, tax related, capital gains, investment income, so forth.
Yeah. Yeah. I think, for years, the 401k goes back to, I think it was officially enacted January 1 of 1980.
Okay.
You could check me on that, but it's ish, right? So, we're still 40 years into the largest savings vehicle in the world. I haven't researched that, but I'd venture to say that's probably true. So 40 years old, it's not that old, right? And for the first few decades, 2 or 3 decades of the 401k, it was, the general advice and planning. And I'm not saying this is always wrong, and I'm not saying it's bad advice today, but it was, you could see it everywhere was, defer as much as you can while you're making a living.
Sure.
And because you'll be in a lower bracket when you retire, right? And so just kind of at the surface level, it's like, hey, that makes sense. Like, I'm not going to be making as much income, lower bracket, I'll defer it, pay it later. And that's worked for some people for sure. Then you have the compounding of, hey, you're not having to pay taxes on those dollars, so you're able to put more in, and then the compounding effect of that. And as time has gone on, and as the consumer, as the investor has become more and more educated, as the advisor has become more educated on this topic, you've started to see people look at this and say, well, this isn't necessarily always true. It's not necessarily always the case, right? So does it make sense for me to defer as much as possible, or every dollar that I'm saving for retirement going into a tax-deferred vehicle? And so that's a big part of what we do with tax planning.
Sure.
Is, does that make sense for you or does it not? What are our thoughts on future tax rates? What is your projected income in retirement? Do you really want your income to be less in retirement? Or do you want it to be the same, right? We have a lot of clients that, or know a lot of people that make $150,000 a year, and they want their retirement income and to be around the same. And so you can't just assume I'll be in a much lower bracket And then you look at our national debt and the tax situation of just where we're at as a nation. So that's a big part of what we're doing with, does it really make sense to continue to defer everything out, or should we start paying some of those taxes now if it's it's not a avoidance of tax, it's just a deference, it's just, do we pay now or later?
Right.
And so,
and for a large percentage of our clients and for the people, the public in general, a traditional 401k makes sense.
sure.
It makes sense. But there are those that it doesn't.
You've seen the industry adapt and adjust with, even like with the IRS and the capabilities that the IRS and is giving people because of now there's a Roth 401k option. Now they're allowing, even though I think employers will be slow to adopt this, they're allowing 401k matches to go into the Roth. There's simple Roths. There's SEP Roths. Like a lot of, it's funny because you can't even really go to a custodian and find someone who offers those accounts yet because they're so new.
Right.
But those options are now being offered, which is, I think, really interesting. But I think, investing is, when we look at tax planning and investing, the difference between an advisor and maybe someone that's just filing your taxes is, an enrolled agent, a CPA, you're paying them to pay the least amount of taxes this year. Like, help me with 2024. I want to pay as little as possible, right? And there's going to be times where they have recommendations and things that you need to be doing that are going to help you this year, but might shoot you in the foot down the road, right? Doesn't mean they're not doing their job. They're just, their perspective and what you're paying them to do is very short-term focused, typically speaking. From an advising perspective, we're looking at things from more of a, over your entire lifetime, knowing that we don't know the future, right? We can't predict where tax rates are going to be, but how do we pay the least amount of taxes over your expected lifetime, not just this year, right? And that you're going to do things a little bit different when you look at that.
As an advisor, I find myself asking a lot of the same questions. What if? We what if this? What if? And so that does require, we use the, especially when we're comparing ourselves between advisors and brokers, that they're transactional, we're more advisory. But it does involve, as an advisor, a lot of forward thinking about situations that may or may not, occur, planning for the situations that, might happen, may not. But it does require us to we're not focused on necessarily this year's tax return. We're looking at
it's a lot of the planning is around having options and flexibility.
Yeah.
And if every dollar of your retirement savings is in a tax deferred vehicle and is going to be taxed when you take it out, it's not bad, but you don't have a lot of options.
Correct.
Right? You're taking income from that, and wherever rates are and whatever the IRS guidelines are at that time, you're subject to that, and that you don't have much flexibility. And so we're a big believer in diversification on the investing side, but also diversification on the tax planning side. Is like, we can't predict, but let's make sure we have flexibility so that if things go this way or that, like, we can take income from different buckets and we have some options.
I know I've used the term, I've heard you use it, most of our advisors use it, having different buckets of resources, of monies available at retirement, because you don't want it all in that traditional IRA, that's subject to RMD. Roth IRAs are not subject to RMD.
Right.
I mean, there's a lot of, and as long as there's going to be a Congress, there's going to be different tax laws, and so they're convoluted, and sometimes we need to sit down and go over those opportunities with clients.
And with an election coming up, I mean, the more I learn about our tax code, which it's the complexity of our tax code is absurd.
Yeah.
I mean, it is outrageous, right? When you go back to the founding of our country and look at how I'm not saying everything was perfect then. We had a lot of things that were jacked up, a lot of issues. But the reason our nation was founded and our country was founded, and you look at things that people were fighting for at that time, and then where we're at today, it's absurd when you think of the number of times an individual dollar is taxed and how you pay taxes. We talked about it a couple weeks ago with John, and he mentioned, if you spend it, if you save it, if you invest it, if you earn it, if you go down the list, it's like your tax. And it's just, I encourage all of you with the election coming up, with future elections, to educate yourself, because that should be at one of the most important things for everybody is how much is the government dictating that we give them,
Yeah.
and have a voice and get me fired up real quick on that. But
When's the next Tea Party?
yeah, maybe sooner than you think.
Yeah.
Anyway, so tax planning is huge. Working with a good advisor, that is, I can make a case that's even more important than the investment side.
Sure.
Right, for a lot of people, depending on your situation. And working with a financial advisor is not just about like how are they performing on the investing side of things, but it's like what are they doing on the planning side? How are they helping you avoid, in a legal way, paying taxes that you don't need to pay along the way. So, any parting thoughts or?
No, it's a good time of year. I like the change of seasons. But yeah, we got a lot going on in the business world, investment world.
We can't help but talk about the weather and seasons. I swear that comes up one way or the
sports.
Yeah, but a lot going on for sure. Fed meeting coming up here in just the next couple weeks, so be on the lookout for that.
Yeah,
and we'll be I'm sure we'll be talking about it. So
I guess we've run off our third person up here. Maybe next week we'll grab Eli or John. But
yeah, well, as always, we appreciate you guys listening. Be sure to subscribe, give us a comment. We really appreciate it. Enjoy you guys jumping in here, and we'll see you guys next week.